If you have a 401k and you're within 10 years of retirement, I need you to stop and watch this whole video, because the number that you see on your statement every quarter, that's not actually all of your money. My name is Samaya. I'm a certified financial fiduciary and the founder of the Legacy Circle. I specialize in helping pre-retirees protect their retirement savings and keep more of their money in their pocket to create income. And what I'm about to share is something that most financial advisors don't even touch on, at least not until it's too late. So first thing first, we know that the government is your silent partner in your 401k. At least I hope you know that. Every dollar you contributed went in before taxes, whether it's a 401k, traditional IRA, that's all pre-tax money, which means the IRS has been keeping track of that amount this whole time. The moment you start taking that money out for retirement, they want their cut. And every dollar you withdraw is taxed as ordinary income. So let's say you get to $500,000 saved for retirement, which sounds great, right? But after federal taxes, if you're in a state with state taxes, after Medicare surges, you could realistically walk away with $350,000 of that 500 or even less, because that $150,000 goes straight to the government for their tax cut. And $150,000 is not a small number, especially when you need this money to last you for the next 20, 30 years in retirement. And a lot of you may or may not have heard of required minimum distributions, or RMDs, which is at age 73, the IRS will force you to start withdrawing. So say you get to retirement age, maybe you have a decent sized pension, maybe your Social Security actually takes care of you. So you don't really need to touch that $500,000 you've been saving in your 401k this whole time. Your plan is just to let it sit and grow and leave it to your kids and grandkids when you go. Well, at 73, the IRS is going to force you to take money out of that 401k, whether you need the income or not, because they want you to start taking money out so they can receive their tax money. And you don't get to choose the amount that comes out. And realistically, the more disciplined you were and the bigger your account grew, the bigger the forced withdrawal. And what people don't talk about with that bigger forced withdrawal is that it can get very ugly very fast. Those forced withdrawals could push you into a higher tax bracket. So now you're paying more in taxes on those withdrawals, which could trigger a higher Medicare premium and even make your Social Security more taxable as well. It's this messy snowball domino effect, all at the same time. This is what financial planners call the tax bomb. So ironically, the more disciplined you were about saving into those accounts, the harder you get hit. A $1 million 401k balance could force you to withdraw $40,000 in taxable income in year one alone. And then that gets added to whatever else you're already collecting. Decades of tax-deferred growth just exploding all at once, when realistically you can least afford a big tax hit because you're in your 70s. And unfortunately, most people don't even find out about this until it's too late to do anything about it. And once your income crosses certain tax thresholds, everything gets more expensive. Your Medicare Part B premiums spike. We're talking hundreds of extra dollars every single month just because your taxable income is too high. This is called IRMAA, and most people have never even heard of it until they get the bill. Then up to 85% of your Social Security can become taxable as well. So that benefit that you paid into your entire working life, the government takes a cut of that too. And you're doing all of this in your 70s, when you're not going back to work, you're not earning anymore, you're just watching more and more of your retirement money disappear to taxes every single year. This isn't a maybe, this isn't a worst case scenario. If your money is sitting in a 401k, traditional IRA, TSP, right now, this is the path that you're already set on. The tax bomb is already set, and most people don't even realize until it's too late to do anything about it. But there is a window if you're 5 to 10 years from retirement. And what you do inside that window will determine how much of your own money you actually get to keep. The move that high-income earners and smart retirees have been using for years is called Roth conversions. Here's the concept. You take a portion of your pre-tax money and convert it into Roth or tax-free money over time to pay the taxes now at today's tax rate while you're still in a lower tax bracket. And then from that point forward, everything grows tax-free. So no RMDs, no Medicare surcharges, no Social Security tax on that portion. The IRS never touches it again. But here's what a lot of people don't realize about doing Roth conversions on their own. If you convert too much in 1 year, you spike your income, you jump tax brackets, and then you trigger the exact problems that you were trying to avoid. You have to be strategic about how much you convert in one given year to stay within your current bracket. And while you're converting, you need your money to sit somewhere safe to continue growing, but without market risk. This is the missing piece a lot of people don't think about. And this is where a fixed index annuity can change everything. Because yes, you can do those conversions inside the market, but if that money is fluctuating with the market, it has fees attached to it, it can mess up the strategy. Versus doing a Roth conversion inside a protected vehicle like a fixed index annuity where there's no market risk, your principal can still be fully protected, but it can still grow with the market and ideally have no fees. Well, that can provide that tax-free retirement that you were looking for in a secure, protected vehicle. You're essentially diffusing the tax bomb 1 year at a time, controlling how much income you recognize, staying out of IRMAA thresholds, keeping more of your Social Security from being taxed, and building a pool of completely tax-free money for the rest of your retirement that continues growing strongly and protected. Most financial advisors are focused on growing your account balances, and there's nothing wrong with that, but they're not focused on what you actually keep after taxes. There's a big difference between $1 million sitting in a 401k and $1 million of money you actually control and keep. This strategy is the difference. Window to do this in is not forever. Tax rates are at a historically manageable level right now, and RMDs start at 73. If you're in your late 50s or early 60s, this is your window and it's closing. So if you're ready to protect what you've built, you have $300,000 or more sitting in these traditional pre-tax accounts, and you're within 10 years of retiring and want to see exactly what this could look like for your specific numbers, then use the link in the description to book your strategy call with me. We'll look at your situation, we'll run the numbers, and then I'll be able to show you exactly how much of your retirement you could be keeping that you're currently on track to give away. Because you didn't spend the last 30 years working and saving money just to give a third of it to the IRS. It's time to think smarter. Use the link in that description and we'll talk soon.